You open a PDF that looks like it was typeset by a very patient lawyer. Articles, paragraphs, subparagraphs with letters that turn into numbers that turn into more letters. Somewhere inside this document is the reason your payment from abroad had tax withheld, and the way to stop it next time. Tonight, we turn treaty speak into plain language. No Latin, no secret handshakes, just a map and a flashlight. A tax treaty is a peace pact. Two countries agree on how to split taxing rights over cross-border income, and how to remove double tax through an exemption or a credit. Treaties don't invent taxes. They allocate who gets first shot and who must step back. Most treaties borrow from the same blueprints, the OECD model and sometimes the UN model. So once you learn the layout, you can navigate almost any treaty like a familiar house. Open that house at the definitions. Early articles define who counts as a resident of a country and what counts as a permanent establishment for businesses. Everything else rests on these two beams. Resident determines who can claim treaty benefits. Permanent establishment determines when a foreign business crosses the line into a taxable presence. If you remember only two phrases tonight, make them those. Start with residency. Each country has its own domestic rules. Day counts, a home available to you, center of vital interests, habitual abode, even where your immediate family lives. You can be resident in both countries at the same time under domestic law. When that happens, the treaty's tiebreaker breaks the tie in a set order. A permanent home, then center of vital interests, then habitual abode, then nationality, and if all else fails, the tax authorities talk to each other. It's not vibes, it's a sequence. Work down the ladder honestly, and you'll know where you belong for treaty purposes. Once residency is pinned down, find source. Treaties don't just ask where you live, they ask where each kind of income comes from. Salary is sourced where you physically perform the work. Business profits are sourced where the enterprise has a fixed place or a dependent agent, the permanent establishment. Dividends, interest, and royalties often sourced to the payer's country, with the treaty capping withholding. Capital gains are usually taxed where the seller lives, except gains tied to real property or shares that mostly reflect real property. Residency and source run through the entire document like a baseline. Now the articles everyone Googles. Employment income looks simple. The country where you work has the first right to tax your salary. There's a famous exception with 3 prongs. The host won't tax your wages if you're in the host no more than 183 days in a defined period. Your employer isn't a resident of the host, and your pay isn't borne by a permanent establishment your employer has in the host. Miss any one prong, and the host can tax your wages, even if you set foot there for only a few weeks. People trip because they count days and ignore the employer residence and borne by conditions. If payroll is recharged to a local affiliate or there's a local branch in the chain, the exception can vanish. Business profits live and die by permanent establishment. If your enterprise has no fixed place of business in the other country and no dependent agent there habitually concluding contracts, the other country shouldn't tax your profits. Rent a real office, keep stock for delivery, let a dependent agent close deals, or simply perform services there long enough under a service PE clause, and you may have crossed the line. From that day, the other country can tax the profits attributable to that fixed place or activity. One desk, one signer, one long project, suddenly you're on the local map. Passive income, dividends, interest, royalties, gets compressed withholding rates. That's the small percentage your client's country can grab off the top. Your resident country then either exempts the income or grants a credit so you don't pay the same tax twice. Each treaty has its own caps, 5%, 10%, sometimes 0. The trick isn't memorizing them. It's finding the right line in the treaty and filing the right form up front so reduced withholding applies now rather than you chasing refunds later. Capital gains bring a sharp fork. Gains from selling real property are taxed where the property sits. Shares in a company whose value is mostly real property can be treated like the property. Most other gains on shares and personal property are taxed where the seller lives, unless they're tied to a permanent establishment. If you're planning a share sale and your company owns a lot of land, the land-rich rule matters more than your passport. Special rooms exist for pensions, students, teachers, artists and athletes, and government service. They're short but powerful. Public pensions may be taxed primarily by the paying government. Artists and athletes often get taxed where they perform, even if money flows through a company. These carve-outs exist because the drafters had real cases in mind. If you fit one, read that article twice. Next comes the relief engine. This is the part that forces your resident country to remove double taxation, either by exempting the item taxed abroad or by taxing it domestically but granting a credit for the tax paid to the other country. Credits usually can't exceed your domestic tax on the same income, and timing differences can sting. A payment taxed abroad in one year might hit your domestic return in another. Good planning is a calendar, not a slogan. Modern treaties add two guardrails: limitation on benefits and a principal purpose test. They fight treaty shopping. Limitation on benefits is a checklist: publicly traded, owned by qualifying residents, enough local substance, or an individual resident. Fail the checklist and some benefits can be denied. The principal purpose test says that if an arrangement's main purpose was to get a treaty benefit, that benefit can be denied. The message isn't "don't plan," it's "plan with real substance." Reading is one thing, using is another. Run a simple ritual whenever money crosses borders. Identify the income type first. Open the relevant article. Lock down residency. Check source. Read the article's conditions slowly. If a withholding cap exists, figure out how to claim it at source. Local self-certification forms, residency certificates, sometimes advanced clearances. Build your home country return around the relief article and keep proof. Residency certificate, treaty article citation, payer's withholding statement, invoices, travel days for wages, and your permanent establishment analysis for business. These aren't burdens. They're your shield 3 years later. Let's make it real. You live in country R, work 3 months in country S as an employee, and your employer has no branch in S. You spend under 183 days, your employer isn't resident in S, and your pay isn't borne by a permanent establishment in S. Under the employment article, S shouldn't tax those wages. Country R does, and Social Security coverage is handled by its own agreement and a certificate. Change one fact: payroll costs recharged to an S affiliate, and the exception can fail. S taxes the workdays in S, you claim a credit at home. Watch for saving clauses. Some countries, famously the United States, preserve the right to tax their citizens and residents as if the treaty didn't exist, with limited exceptions. If you hold a U.S. passport, you don't get to waive the treaty like a universal shield. You still file the U.S. return. The treaty helps you assign rights and claim credits. Other countries have similar flavors. Read that clause twice. It tells you which benefits actually survive. If both countries grab the same income, or one applies the treaty badly, there's a backstop called the mutual agreement procedure. You file with your resident country's competent authority. They talk to the other side. It's slow, but it exists for real collisions. Use it when you've done everything right and ended up in a double tax cul-de-sac. Social Security loves to ambush travelers and sits outside income tax. Treaties don't govern it. Separate agreements do. In the EU, coordination rules keep you contributing to one system at a time. The United States has totalization agreements letting you stay in your home system for a limited time while abroad. The proof is a certificate of coverage. Without it, 2 payroll systems may claim you. Income tax relief doesn't rescue social contributions, so plan both together. To avoid admin overload, adopt a minimal rhythm. Before a cross-border payment, decide the income type and open the treaty article. Confirm your residency. Have a current certificate ready. Complete the payer's reduced withholding form properly. Track days and work location for wages. For business, write a short memo on permanent establishment risk: where you work, whether you rent space, who negotiates and signs, how long projects run, whether you keep inventory or hire locally. For passive income, keep the withholding statement and residency certificate together. When you file at home, line up each foreign tax item with its credit and keep the proof in a folder by country and year. Boring habits win audits. There are recurring traps. People waive a residency certificate from country Y and think it overrides country Z's claim when their family, home, and business are all in Z. The tiebreaker ignores the paper and follows facts. Employees rely on the 183 myth and forget the borne by clause. The host taxes the wages anyway. Freelancers rent temporary offices and let a local agent close deals. They created a permanent establishment without meaning to. Investors forget land-rich rules and walk into source country tax on a share sale. Creators see platform withholding as random, when it's the treaty rate applied badly because no form was filed. The cure is always the same. Read the right article, align your facts with its conditions, and document. A clean two-step test makes the whole maze simple. Step 1. Where are you a treaty resident this year? Use the tiebreaker if needed. Step 2. What is the income type and where is it sourced under the treaty? Pair those answers with the article's rule. If the source country is allowed to tax, accept the withholding or file a local return, and then apply the exemption or credit at home. If the source country is not allowed to tax, claim the reduction at source with the right paperwork. If both claim the same item, prepare to use the mutual agreement procedure. Repeat for each income line, and the treaty turns from a thicket into a checklist. Treaties won't make you invisible. They make you legible. They work best when your life has shapes the articles recognize. Clear residency, clean sourcing, no accidental local footprint, and paperwork done before money moves. You can still live globally. Months here, months there, projects across borders, dividends from companies you backed years ago. The difference between chaos and control is 30 minutes with a treaty and a habit of writing down what you found.